For the past several weeks, silver has been framed as a coiled spring sitting just beneath the $70 level, with implied volatility near 85 signaling an imminent breakout. The argument sounds compelling on the surface. Gold has already entered price discovery territory above $4,400 futures. The dollar index slipped below 100. Industrial demand remains strong, and the options market appears to be pricing a large directional move. But when you step back and examine the structure more carefully, the evidence does not necessarily support the conclusion that silver is preparing for a sustained upside expansion. In fact, the same data points being interpreted as bullish signals may instead be warning signs that the current setup is fragile and potentially vulnerable to downside repricing rather than breakout continuation. The first issue lies in the interpretation of volatility itself. A spike in implied volatility to 85 is often described as a signal that a major directional move is approaching. That is true in some cases, but volatility expansion does not predict direction. It predicts uncertainty. And historically, periods of elevated implied volatility in silver frequently coincide not with orderly breakouts, but with disorderly liquidation phases. In other words, volatility at this level should not automatically be interpreted as confirmation of strength. It may instead reflect positioning instability. Markets do not reward consensus expectations indefinitely. When traders begin to collectively anticipate a breakout, options markets tend to price that expectation in advance. If the anticipated move fails to materialize quickly, volatility premiums compress and price frequently follows. That is especially relevant when silver has already experienced extreme appreciation over the prior cycle. After rising approximately 148% during 2025, silver is no longer a neglected asset waiting to be discovered. It is already a crowded trade, and crowded trades do not require negative fundamentals to correct. They only require expectations that become too optimistic relative to immediate catalysts. Another overlooked factor is the divergence between gold's strength and silver's hesitation. The prevailing narrative suggests silver is simply lagging gold and preparing to catch up. But markets do not always move in synchronized phases. Sometimes divergence exists because one asset is signaling caution rather than opportunity. Gold's advance above $4,400 futures reflects its role as a reserve asset, responding to macro uncertainty, sovereign debt concerns, and central bank diversification flows. Silver, by contrast, remains heavily exposed to industrial demand expectations. That distinction matters. If global growth expectations weaken even marginally, silver's industrial exposure becomes a liability rather than an advantage. Copper's strength near recent highs has been cited as confirmation that industrial demand remains intact. However, copper strength alone does not guarantee continued expansion across the broader industrial metals complex. Copper often leads turning points, but leadership can precede both upside continuation and downside reversal. The assumption that copper strength must translate into silver strength is therefore not structurally reliable. The same caution applies to the interpretation of dollar weakness. Yes, the DXY slipping below 100 historically supports precious metals, but correlation is not causation. And more importantly, correlation regimes shift. Dollar softness during periods of policy uncertainty does not necessarily translate into sustained metals repricing if real yields remain elevated or if liquidity conditions tighten elsewhere in the system. And that brings us to the most important structural question investors should be asking right now. If silver truly had strong momentum behind the breakout thesis, why has the market repeatedly failed to hold above the $70 threshold despite multiple attempts over 3 consecutive weeks? Repeated rejection at a major psychological level is not evidence of suppressed upside energy. It is evidence of resistance that continues to function effectively. Markets reveal conviction through acceptance above resistance, not through repeated tests beneath it. When price compresses beneath resistance while volatility rises sharply, the more common outcome is not expansion upward, but expansion outward followed by directional resolution lower. This does not guarantee that silver must decline, but it does suggest that the probability distribution around current levels is far less asymmetric to the upside than many traders appear to believe. And that distinction matters because positioning decisions made under the assumption of inevitability rather than probability tend to produce the largest losses when markets move unexpectedly. One of the central arguments supporting the bullish silver thesis is the recent decline in the US dollar index below the psychological 100 level. Historically, dollar weakness has often preceded strength in precious metals, and at first glance, this relationship appears to reinforce expectations for a breakout above $70. But the critical mistake investors make is assuming that correlation automatically implies continuation. The dollar falling below 100 is not by itself a structural shift. It is only meaningful if it remains below that level long enough to reflect a change in global liquidity conditions rather than short-term positioning adjustments. Currency markets frequently overshoot technical thresholds during transitional policy periods, especially when investors are repricing expectations around Federal Reserve leadership changes or future rate trajectories. Temporary weakness should not be confused with regime change. In fact, what matters far more for silver than the nominal dollar level is the direction of real yields. If real yields stabilize or begin rising again, even modestly, the opportunity cost of holding non-yielding assets increases immediately. That shift historically weighs on silver more aggressively than it does on gold, precisely because silver lacks gold's reserve asset status inside the global financial system. This distinction is often overlooked in simplified breakout narratives. Gold benefits from central bank accumulation and sovereign diversification flows. Silver does not. Silver's price behavior depends far more heavily on investment flows that are sensitive to liquidity expectations. When liquidity tightens, silver typically reacts faster and more violently than gold. That makes the current environment far less supportive than it appears at first glance. Another commonly cited bullish argument centers on inflation pressure from elevated energy prices. Oil trading near recent highs is frequently interpreted as confirmation that inflation remains persistent and therefore supportive of metals. But inflation alone does not guarantee higher silver prices. What matters is whether inflation is accompanied by easing financial conditions or tightening financial conditions. If inflation remains elevated while central banks maintain restrictive policy frameworks, precious metals often struggle rather than advance. In those environments, inflation becomes a constraint rather than a catalyst because it delays monetary easing. And without monetary easing, liquidity expansion remains limited. That is particularly relevant right now because markets appear to be pricing both inflation persistence and eventual policy accommodation simultaneously. Historically, those expectations rarely materialize at the same time. Either inflation declines and easing becomes possible, or inflation persists and policy remains restrictive. Silver cannot benefit equally from both scenarios. The industrial demand narrative surrounding solar expansion, electric vehicles, and artificial intelligence infrastructure is another pillar supporting expectations of a structural breakout. There is no question that these sectors require significant quantities of silver. However, structural demand projections extending toward 2030 do not necessarily translate into immediate price acceleration today. Markets price marginal, changes in expectations, not long-term themes that are already widely recognized. Solar demand growth, EV adoption curves, and data center expansion have been discussed extensively for several years. They are not new catalysts. When a theme becomes consensus, its ability to move price diminishes unless actual supply shortages begin appearing faster than expected. So far, that has not happened in a way that forces immediate repricing. Even the argument that silver supply may only meet between 62 and 70% of demand later in the decade does not automatically support near-term upside continuation. Commodity markets routinely trade through projected deficits for extended periods without responding immediately, especially when inventories remain sufficient to buffer short-term disruptions. Forecast deficits influence long-term allocation decisions, not necessarily weekly breakout behavior. That distinction becomes especially important when traders attempt to translate multi-year structural projections into short-term directional trades. Silver's recent compression beneath $70 should therefore not be interpreted solely as energy building for a breakout. It may instead reflect a market waiting for confirmation that liquidity conditions will actually support the move investors are expecting. Until that confirmation appears, the macro environment remains ambiguous rather than decisively bullish. And ambiguity, in markets with elevated implied volatility near 85, is rarely a stable foundation for aggressive upside positioning. Another widely repeated argument supporting the bullish silver setup is the idea that short positioning stacked beneath the $70 level represents compressed energy, waiting to trigger a squeeze. The narrative suggests that once resistance breaks, those short positions will unwind rapidly and accelerate the move higher. But market structure does not always behave that way. Short positioning near resistance does not automatically signal vulnerability. In many cases, it reflects conviction from institutional traders defending levels they consider technically and fundamentally justified. When resistance holds repeatedly for multiple sessions, as silver has demonstrated beneath $70 for several consecutive weeks, it often indicates that supply is being actively distributed rather than passively absorbed. That distinction is critical. A true squeeze environment usually appears when resistance breaks quickly after only brief consolidation. Extended compression beneath a ceiling typically suggests balance rather than imminent release. Instead of building explosive upside momentum, the market may simply be forming a longer consolidation base before resolving direction later. This interpretation becomes even more relevant when implied volatility rises sharply during the compression phase. Volatility near 85 is often interpreted as confirmation that traders expect expansion. But elevated volatility can also indicate uncertainty about direction rather than confidence in continuation. Options markets frequently price risk asymmetrically when traders hedge both upside opportunity and downside exposure simultaneously. In those conditions, volatility becomes expensive, and expensive volatility rarely remains elevated indefinitely. When volatility premiums begin to normalize, price frequently adjusts alongside them. That adjustment does not have to be dramatic. Even a modest retracement toward prior consolidation levels can reduce volatility significantly without changing the long-term trend. But for traders positioned aggressively for immediate breakout continuation, that normalization can feel like a structural reversal. This is especially true in silver because leverage within the derivatives market tends to amplify short-term moves far more than in gold. Another overlooked factor is the behavior of the gold-silver ratio during periods of divergence. The current narrative assumes silver must eventually catch up to gold because gold has already entered price discovery territory above major resistance. But the gold-silver ratio does not always compress through silver strength. Sometimes it compresses through gold stabilization instead. If gold pauses after its recent advance, while silver remains range-bound beneath $70, the ratio can normalize without requiring a silver breakout at all. That scenario would invalidate one of the most commonly cited arguments supporting immediate upside continuation. There is also an assumption that physical silver tightness in vault inventories automatically increases the probability of a squeeze. While declining inventories can contribute to stress inside the paper market, physical tightness alone rarely determines short-term price direction unless accompanied by visible delivery disruptions. So far, the market has not shown evidence of systemic delivery stress capable of forcing repricing across the futures curve. Instead, what we are seeing may be something more typical of late-cycle commodity behavior. Strong, long-term structural demand expectations combined with short-term positioning uncertainty. In those environments, price frequently consolidates longer than expected before choosing direction. That is particularly important right now because markets are simultaneously pricing inflation, persistence, policy uncertainty, and growth resilience, all three of which influence silver differently. When multiple macro signals point in different directions at the same time, volatility increases, but clarity decreases. And in markets where clarity decreases, while expectations increase, breakouts become harder, not easier, to sustain. At this stage, the most important mistake investors can make is assuming that silver's current compression beneath $70 represents a delayed breakout rather than a conditional setup that still requires confirmation. Markets rarely reward certainty before confirmation appears. The dominant narrative suggests that dollar weakness, gold's breakout above $4,400 futures, elevated implied volatility near 85, and long-term industrial demand trends together create a high-probability environment for silver to accelerate higher. But when multiple bullish signals become widely recognized at the same time, they often stop functioning as catalysts and begin functioning as expectations already priced into the market. And expectations that are already priced in rarely produce explosive continuation without a new trigger. That is why the most important question right now is not whether silver can break above $70. The more important question is whether the market can sustain acceptance above that level after the breakout occurs. Because acceptance, not penetration, is what defines trend continuation. If silver briefly trades above $70 but fails to hold the level on consecutive daily closes, the move would likely represent liquidity-driven positioning rather than structural repricing. In those conditions, breakout attempts often become exhaustion signals rather than confirmation signals. This distinction matters especially in environments where implied volatility is already elevated. When volatility is near extremes, markets tend to require stronger confirmation before sustaining directional expansion. Without that confirmation, price frequently rotates back toward prior consolidation zones as volatility premiums normalize. That makes the downside scenario investors are currently ignoring far more relevant than it appears. A daily close below the $65.80 level would not simply represent short-term weakness. It would signal that the compression structure beneath resistance has failed to resolve upward. In technical terms, that would shift the market from breakout anticipation into range extension behavior. And once that shift begins, the next logical support zone near $63.50 becomes increasingly likely to be tested. At the same time, investors should not overlook what is happening in the dollar. If the DXY stabilizes and reclaims levels above 101.5 for several consecutive sessions, the tailwind supporting metals repricing would weaken materially. Silver tends to react faster than gold to changes in currency strength because silver's investor base is more sensitive to liquidity conditions than reserve diversification flows. In other words, the dollar does not need to rally aggressively to pressure silver. It only needs to stop falling. Another overlooked risk comes from the assumption that long-term structural demand automatically supports near-term price acceleration. Solar expansion, electric vehicle adoption, and AI infrastructure growth are real forces shaping silver demand through the end of the decade. But structural demand trends influence allocation decisions over multi-year horizons, not weekly breakout behavior. Markets move when expectations change, not when expectations remain constant. And right now, the structural demand story is already widely understood. That means the next major move in silver is far more likely to be determined by liquidity conditions, positioning adjustments, and confirmation signals from gold and the dollar than by long-term supply forecasts alone. So what should disciplined investors actually be watching this week? First, whether silver can produce consecutive daily closes above $70 rather than brief intraday moves through resistance. Second, whether gold maintains stability above the $4,320 confirmation zone rather than reversing lower after its breakout attempt. Third, whether the dollar index remains structurally below 100 or begins reclaiming lost ground. These signals together define whether the current compression resolves upward or resets from lower levels before attempting another expansion phase later in the cycle. Because the real opportunity in markets does not come from predicting breakouts. It comes from recognizing when the structure supporting a breakout is either strengthening or quietly beginning to fail.